Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good afternoon. Ira Epstein of Linn Associates with your financial market update for Monday, the 19th of March, 2018, and we're about 4:40 p.m. Central Daylight Time. Crazy markets. Last night I gave an education, if you will, in my reports to my subscribers that work with my research. And I was showing them how the history works of tariffs and what happens. In a nutshell, and I won't go into the whole history, the dollar typically falls. Tariffs are inflationary. You could get a bounce in the metals because of it, and nobody wins. That's the reality. Our president can call it all he wants, protectionism. At the end of the day, it's a loser. And it's a loser because in order to get our intellectual property rights back, and believe me, China has stolen them. If he goes and taxes 45% of the goods we import, the costs go up. He might think it's worth doing that, and away you go. I can't answer that part for you because I don't want to get into what's right, what's wrong, should people be able to steal that. That's not what we're talking. We're talking the markets. That's it. Morally, I'm with us, not with them. You can count on that. So I look at it, where are the opportunities? Well, you got a bounce in the gold, but you haven't begun a trend. The dollar got hit. The stock market late in the day rallied back smartly, but you were down 500 points at one point today. I didn't think going into the G20 meeting things were going to be good. How could they be? You've got to imagine all of our partners are wondering, can I get out of those tariffs you're talking? How do I get my exclusion? Can you imagine what it's all about? And then behind that, and it's only, remember, we're at March 19th. I think it's May 13th or so. The president can back out of that nuclear deal with Iran. What is that going to do for oil prices and the like? You have another 45 days of a lot of activity ahead of you. Now, in the Fibonacci levels on the S&P from the top to the bottom, and this was that break that we had from really the end of January right to the beginning of February. And I went on record then stating, and did it in my reports, that I think the market topped out on January 28th, and taking that top out is going to be a very difficult process. I hope I eat crow. I want to be wrong, but these charts aren't looking that way. You got up, you had two rallies nicely above the 68 percentage point area, and you've fallen back into that 50% area. Okay, I can live with that. When you come back to the weekly area chart of closes, weekly, the market's pulling back again to that 18-week average of closes. That number's 27.1860. And the low today was 26.97 and a quarter. You haven't closed under it. But understand, in 2016, you didn't do that. So this, if it happens, is the second time it's doing it now in 2018. That is not a sign of strength. When we look at a daily bar chart, this is how you look coming in today. It wasn't quite as bad as people might have thought. When that market let go and it took out Thursday's low, it just didn't look back, to be honest with you. And what it did is, because of that, and I'll take you back there one more time, you had at that point higher lows, higher highs. 27.45, in my opinion, was the key to the market because it did several things. Let me show them to you. First off, by taking it out, lower highs, lower lows. You might say, Ira, what if I sold it under 27.45? And I'm saying, fine. Your risk would have been one tick over Friday's high of 27.66 and a quarter. And I realize that looks easy, but you're at $1,100. Most of you don't want to risk $1,100 on a trade, and I get that. Don't get me wrong. I'm just saying what it was. Where's the key moving averages? In order to sell it, you were above the key average. You had to come back and hope to get a rally to that point, and then your risk expanded out to $1,200. So it's a break that, don't get me wrong, there's probably a lot of people that caught it, but catching it, not as easy as it looks. A lot of risk, and selling under 27.45 originally, no, that would have been still over the 18-day average by the time it got under it, and I didn't care either ways. I used money management, and I just said, I don't see a trade there. Could it have been another way to trade it? Maybe, but that's what I'm seeing. Next stopping spot could be the 100-day average. Where's the Bollinger Band? The Bollinger's under it. So I have two areas of support right under the market. I've got the 26.90, the 100-day average. I have the 26.8260, the Bollinger Band, and I have the market in a downtrend with downside bias and resistance back up, let's call it 27.43. Momentum just turning down. So this market's all bearish. Just want to go out and say it. It's all bearish. You have to take out 27.66 to negate that at this point in time. In the NASDAQ, momentum down, bias down, trend down, all bearish. Could go to the lower Bollinger Band. The 100 days way under that. What negates it? Take out 70.84. 70.84. 75. Just not used to saying 70.84. When we get to the Dow, it's been more bearish than the others. If we take away today's action, this is what you were looking like. But here was my problem. You'd been holding the 100-day average. You had the existing legacy of higher lows, higher highs until Friday. Friday, you had lower highs but higher lows. The reason I've got those arrows down is today's action. Today, when you broke through that low, that did it. Now, where did the market go? If you look at the low of 24,461 and you look at the 100-day average, 24,647, and it just missed the lower Bollinger Band. So in between those numbers was the initial support. The market is caught in this sideways action. I want to come back to the other charts. Not quite a sideways action there, very sideways in the Bollinger Bands. From sideways action, you get moves, directional moves. So just something I have to bring up there. The Russell today was unable to close under the 100-day average. So while the trend is down on the swing line, lower highs, lower lows, and momentum is turned down, the momentum, when it lost the embedded reading, it had one right through here. When it gets under 80 on Thursday, it's calling for price and the 18-day average, in theory, to come together. Do they have to? No. Do they most of the time? Yes. Go back and you'll see what happens. Do your own work. Now, market comes up. I'm still looking for that, and today it hits that 18-day average. Now the market's neutral again. I see more of the stock indices bearish than I see bullish, and that's important. That's a change of thought process. In the VIX, what the VIX had done is it came down into the past support area right through here of all this sideways action, checked it out, didn't stay down, and has re-entered its uptrend. But notice the black dashed lines, how narrow they are. You're again in that. The volatility of this market from that break back in January that we carried right through Feb is gone. That volatility's come out of the market. These markets, even with 500-point swings in the Dow today, aren't getting the volatility moves that we saw before in the VIX. But if you look at how narrow they were right here, and you look at how wide they are, it's still about double the volatility. Always take that into the back of your mind to know the creature you're playing. In the bond market, the dilemma here is the Fed Open Market Committee starts tomorrow. It ends on Wednesday. The market is built in like a 94% chance that the 10-year, well, actually that their popular interest rate, let me put it that way, now with the 10-year, with the popular interest rate that they maneuver is going to go up a quarter point. The market's going to be looking at the dot plot to see if the Fed's getting fearful of these trade war talks, what's going on, tariffs going on, or more aggressive. I can't imagine them getting more aggressive, but that's just me. I also see a market that is trying to back off a little bit here for some support. I've read a lot of ideas, and people have taken in these trade wars and these tariffs, and they're fearful that you're not going to get a lot higher in these bonds in terms of real yields if that goes through. Other ideas, not saying this all can't go through and happen, just giving you what I'm hearing. When I look at the 10-year note, it fell back to support today at the 18-day average and acted well. The market is not over a 70 reading. It's not overbought. You just got to decide what do you want to do in front of an FOMC meeting. And by the way, on I think it's Thursday we get the Bank of England, but you might want to check that with your broker. In the dollar index, we got hit today, closing 89.33 under the 18-day average of closes. So we've had the swing line making what? The higher lows. If we come here, Friday's high was 89.95, and if I come back to the prior high, 89.93. You always do that to find out where you're at. So coming into today, I had the higher lows, higher highs. If somebody was buying, they were buying maybe at the 89.54 level, and their risk would be one tick under that low if they were paying attention to those patterns, and that's about where you finished right now. If I take a look at the euro, you've got, remember, it's a flip-flop of it. Lower highs, lower lows with a big reversal day back up, negated the downtrend. If anybody wanted to go short this market at 124.15, well, their risk was going to be about $1,100-1,200 bucks. So depending on what the risk factors is, I can't tell you. The Brits got a great piece of news out of the European Union. It said that they're going to give them basically 2 years, and many of the things that the Brits wanted are being given to them. So now we're getting to a better stage in the Brexit, if you will. The market got up to its upper Bollinger Band. It's been in an uptrend. It is overbought as well. When we come to the yen's got a pattern of lower highs, lower low. It's refusing to close under the 18-day average. I'll call it neutral. Bitcoin. Bitcoin is trying to develop an embedded reading, and if it develops it, wouldn't be surprised that you get to the 7,700 level. You have to get back up here over 88.65 to negate this current downtrend. In the Brent versus WTI, back up to the $4 range. Again, this market's going to start listening to a bunch of what's going on concerning Iran, a real lot. And the G20 was the first spot to hear it. And, of course, you get worried about it, and is that going to give Brent maybe now a little bit more of a boost if you take out Iranian oil down the road? And, again, this is a May contract. So all these thoughts come in. When you go to the May Brent, you've got the pattern of higher lows, higher highs. That's bullish. The market's at support at 65.37. Momentum is up, not yet overbought, knocking on the door, but not there. And you'd have to get under here, 64.05, to break the current uptrend. In WTI crude, higher lows, higher highs, bullish. You'd have to get way under here to break the trend, 60.18. That's an awful big spot. It's almost like the Brent, $2 away. If the market can rally, and it is in an uptrend, then 63.77 becomes a potential target. In the gasoline, the market's right into a resistance point, the combination of the 100-day average and the 18-day average. The swing line has higher lows, higher highs. The close today right over that 18-day average. Everything is still bullish on this market, and the seasonals pretty soon start kicking into the upside, whereas the nat gas ran out of its steam that we had talked about here, way up at the 100-day average in the upper Bollinger Band, and now it's fallen all the way back down. It lost its uptrend. It did what it had to, and it's probably time for us to get away from the April and move on to the next contract anyways. Well, over the weekend, what I'm now doing are financial price counts. So I'm covering the financial markets with them, and I enjoy doing it. I begin either Saturday or Sunday, and I do 8 charts on it. You might want to see what I'm doing. Once a trend sets in, it's a way of measuring where that market might go. And yes, you're going to say, well, how do I know a trend set in? I promise you, it is right there. We have 2 PDFs to teach you how to do it. You can do it right on the charting software. The setup comes, and then you need the confirmation, which it's a certain way that we explain to you, the way you go from there. Call us. Go to our website if you want to see how this all works. And by the way, it's something that we give you with the charting software and all for you to play with. Come up here, and if you talk to my brokers, ask them if you can get my copy to be sent out to you. I'll be happy to send out what I did just Sunday night. Take care. Talk to you tomorrow.